All right, let's talk trading. Every single trader I know obsesses over one thing, finding that perfect entry. But what if I told you that's actually the least important part of a profitable trade? Yeah, today we're going to flip that entire script and focus on the one skill that truly determines if you make money or not, mastering the exit. I mean, just think about it for a second. When you're starting out, what's the holy grail? It's that one magic signal, right? That perfect chart pattern, that flawless indicator crossover that just screams buy now. We spend all our time, all our mental energy trying to nail that exact moment we get into the market.
But here is the secret that most people miss. While everyone is laser focused on the front door, the real money, the consistent profit is decided by how you use the back door. Seriously, your long-term success is not defined by how you get in, but by how, when, and most importantly, why you get out. This is the pro's edge.
So, let's drag this blind spot right out into the open and put it under a microscope. Honestly, mastering your exit strategy is the one thing that separates consistent winners from the traders stuck in that boom and bust cycle. So let's get to it. Let's build a real plan for getting out. First things first, we gotta talk defense. Any good strategy starts with protecting what you already have. And in the world of trading, your shield, your absolute first line of defense against a big, ugly loss, is the stop loss.
Now here's what you've got to understand. A stop loss isn't just some random price you pick out of thin air. Its real job is to be the executioner for a bad idea. It should only get triggered when the market looks you in the eye and says, hey, you know that reason you got into this trade? Yeah, that's not valid anymore. It is your logical, pre-planned eject button.
And not all stops are created equal. On the one hand, you have the logical, technical stop. It's placed based on what the market is actually doing, like just beyond a key support level. It listens to the chart. But then, on the other hand, you have the arbitrary percentage stop. This thing completely ignores the market's message. A 2% drop could be totally normal noise, or it could be the start of a total collapse. One is a strategy, the other, well, it's basically a guess. And your defensive toolkit has way more options. You've got volatility-based stops, often using a tool called ATR, that automatically give the trade more room to breathe when things are choppy. You've got time-based stops for getting you out of trades that are just dead money. And then there's the trailing stop, an amazing tool that follows the price up, locking in your profits as you go. Okay, defense is covered. Now, let's play some offense. A stop loss protects your money, but the take profit order is what actually grows it. This is your game plan for cashing in your chips when a trade goes right. So, a take profit order is basically your predefined finish line. Before you even click buy, you should know exactly where you plan to get out if you're right. Why? Because it takes greed and emotion completely out of the equation. It forces you to trade with a clear, rational objective. And just like with stops, you've got options for setting your targets. You can aim for a logical technical spot, like the next major resistance level. You can target a multiple of whatever you risked. We're going to talk a lot more about that in a second. You can even take partial profits, sell a piece to lock in some cash and let the rest of the position run. Super flexible. Okay, this next part. This is where it all clicks into place. We've got our shield, the stop loss. We've got our target, the take profit. Now let's connect them with the simple, beautiful math that is the foundation of all successful trading. I want you to really think about this question. How is it possible to be a profitable trader while being wrong more often than you're right? It sounds completely backwards, doesn't it? It just defies common sense. But in trading, the answer lies in one incredibly powerful concept. And here it is, the risk-to-reward ratio. It is nothing more than a simple comparison between how much profit you're trying to make versus how much you're willing to lose if you're wrong. Make no mistake, this little ratio is the engine of profitability. And it's so easy to figure out. Let's say your stop loss means you could lose $100, and your take profit target means you could make $300. Well, that's it. You've got a 3-to-1 risk-to-reward ratio. You're risking $1 to potentially make $3. Simple as that. And this is where the magic happens. Look at this. If you're risking 1 to make 1, you have to be right more than half the time just to break even. That's a lot of pressure. But look what happens when you target a 2-to-1 ratio. Suddenly, your required win rate drops to just 33%. And at 3-to-1, you can be wrong 3 out of 4 times and still make money. This is the whole game right here. Professionals focus on the size of their winners, not just how often they win. Okay, so the theory is powerful, for sure. But how do we actually put this stuff into practice? Well, the key is knowing that your exit strategy can't be set in stone. It has to be flexible. It needs to adapt to what the market is doing right now and, of course, to your own personal style. You have to read the room. When a market is in a strong, clear trend, you use a wider trailing stop to give that trade room to run and capture a big move. But in a choppy, sideways market, you flip the script completely. You use tight stops just outside the choppy area and aim for quick profits on the other side. You've got to play the game the market is offering you.
And of course, your time frame changes everything. A day trader, who's in and out quick, might be perfectly happy grabbing small, one-to-one risk-reward wins. But a swing trader, who's holding for days or weeks, they're going to use wider, structure-based stops to hunt for those much bigger home runs, the 2-to-1 or 3-to-1 winners. Different games, different rules.
So as we start to wrap this all up, I really want to drive this main idea home. After looking at all of this, the stops, the targets, the ratios, the conclusion is just inescapable. The exit is everything. Let that sink in for a second. Finding a good entry, that just buys you a ticket to play the game. But having a clear, well-defined, and disciplined exit plan, that's what actually determines if you win the game over the long haul. It's not part of the strategy, it is the strategy. So, I'm going to leave you with one last question. I want you to take a hard, honest look at your own trading. Are you still just gambling, chasing the thrill of the perfect entry and just kind of hoping it works out? Or are you operating like a business owner, like a professional, with a clear, logical plan for every single exit, win or lose? Because the answer to that question, well, it's going to define your entire future as a trader.